In today's video, we're breaking down a fascinating interview with Dan Ives, Global Head of Technology Research at Wedbush Securities. Dan explains why he believes the AI ghost trade is dead and why the market is finally starting to separate the real AI winners from the losers. He also shares his thoughts on Salesforce, Snowflake, and the possibility of a future Tesla and SpaceX merger. First, I'll show you the actual Bloomberg surveillance interview clip. Then I'll give you my own detailed reaction and breakdown of Dan Ives' biggest insights, what they mean for investors, and where I agree or disagree with his outlook. After that, I'll take it a step further and reveal 3 of the smartest growth stocks I believe investors should be watching right now. With that said, let's hear what Dan Ives has to say.
Dan joins us now for more. Dan, good morning, good to see you.
Great to be here.
What is separating the winners and the losers right now in this space?
Look, at least did a great job talking about it comes down to monetization of AI. Now, look, it started off Palantir, then you saw Datadog. Snowflake, I view as really a seminal quarter for the software.
Just describe what they do and why they're in the sweet spot right now.
So if you think about the data layer, what this is really showing is LLMs, as the models are ultimately getting deployed, the data warehousing, who the middle layer. As companies go down the use case path, you need a Snowflake. So the point is that you're trying to now find companies in the second, third, fourth derivative who are actually going to benefit. You have chip players over here. You have the hyperscalers over here. In the middle is a Palantir, is a Snowflake, is a MongoDB. And I think what this shows, I call it the AI ghost trade, you can't just paint every company with the same brush, saying that Anthropic's going to destruct software. Snowflake's basically saying, this is a Jalen Brunson-like quarter.
Just to sort of frame this in a more comprehensive way, when you take a look at Salesforce versus Snowflake, how do you identify a moat that is enough for a software company to be sustainable in an AI era?
Yeah, and Benioff, look, back against the wall, right? And you're talking about 150,000 customers. Now you have to show Agentforce clearly was what I view as a pretty big step in the right direction, but we're still talking 3-4% of revenue. It's not significantly moving the needle. Now you guys show over the next 2, 3, 4 quarters that they're able to monetize 15-20% of the customer base. And that is right now, I wouldn't call it a race against time, but that's why there's so much pressure on Salesforce, pressure on Oracle, pressure on Adobe. Look what happened to Intuit. And I think that's why it's investors, winners bracket, losers bracket. CrowdStrike, Palo Alto, winners bracket on cybersecurity. Zscaler obviously got put in the losers bracket.
I'm just trying to figure out if there's some sort of generalities we can that we could make about what these brackets of the winners look like and what these brackets of the losers. I mean, I can have the Lisa bot do my taxes, which is why Intuit's struggling. You can potentially have different kinds of homegrown bots do a lot of the different functionality. You can't have somebody manage your cloud data in a comprehensive way, the way that Snowflake is going to do in tandem with Amazon Web Services. So is there some kind of characteristic of what the winning feature really is for software today?
It's one word, it's data. I mean, data is the new oil, the new gold. And who has control over that data? That's what's going to separate winners from the losers. Snowflake, front and center on data. Palantir, front and center on data. LLMs, the models, they're not going to commoditize data. They could commoditize pieces of software. We see a UiPath and some others. You see it on Intuit. So that's why investors are trying to figure out which bracket. If you're in this bracket, stock's up 30-35%, and I think going higher. On the other side, like a Salesforce, they need now to prove it over the next 6-9 months. And Benioff is used to being Mount Rushmore, obviously at the top of the mountain. This is, I think, for the first time, a true test. I think they'll ultimately succeed. But this is definitely, pressure environment.
So for Snowflake, if it was a Jalen Brunson quarter, was for Salesforce this like a James Harden quarter?
Oof. I would, and that would be hard, a little too harsh, but I'd say
you just said he has 6 months to prove himself.
Yeah, look, I'd say it's one where if you look at Salesforce right now, they're in a situation where it's a Cleveland Cavaliers situation where you had definitely green shoots, but now you got to prove yourself out. And I think Benioff understands the challenge there, what they need to do, but it comes down to investors need to see execution, monetization. That's going to be front and center.
What wouldn't you touch in tech right now?
Well, look, to me, I think you want
to sell. What would you avoid?
You want to continue to own chips. You want to continue on software. I think the areas, like if I look at like where Adobe plays into it. I think IT services is areas you want to, right now I think avoid in terms of, some of those components. And I think it's the legacy names, specifically in software and infrastructure, that you don't think that they're going to be able to turn around. I think it's truly a stock picker's market in terms of what we're seeing here play out.
Can we finish on Tesla? SpaceX IPO later this year. It's going to be a blockbuster, massive numbers we're talking about here. And then an additional sideline conversation whether Tesla becomes one with SpaceX. What do you think about that as an analyst?
I think that is, we've talked about it's the no-brainer move. We think 80 to 85% chance that we're sitting here a year from now, SpaceX and Tesla have gone down the aisle in terms of marriage. Because to me, that is one. In SpaceX, clearly being from an IPO perspective, you had the XAI, integrated there. But when it comes to Tesla, from a data perspective, from AI, from an engineering cross-pollination, I think that's the grand vision for Musk. And I just continue to view this is a step process, but I think that the extremely high chance that that's emerged.
What does SpaceX get out of it?
Well, for them, you get the data, you get the engineering, you get ultimately what I view as autonomous physical AI, combined with what SpaceX bring, obviously, on the space and when it comes to Starlink and the foundation. And look, there already is cross-pollination between Tesla and SpaceX, but I think this would really be more of an official sort of combination. I think it's all part of the grand vision of Musk, in terms of he's almost building out his own, just like NVIDIA and The Godfather, they're making stakes in companies. Musk has almost done it really step by step here.
After watching this interview, I think the biggest takeaway is that we are entering a new phase of the AI boom. The first phase was all about excitement and speculation. The second phase is all about monetization. Investors no longer care about who talks about AI the most. They care about who is actually making money from it. One of the first points Dan Ives makes is that the market is becoming increasingly focused on AI monetization. In other words, investors want proof that artificial intelligence is generating real revenue and creating real business value. For the last few years, many technology companies benefited simply from mentioning AI during earnings calls. Investors were willing to give management teams the benefit of the doubt because everyone understood that AI had enormous potential. But now that we're deeper into the AI cycle, potential alone is no longer enough. Dan points to companies like Palantir, Datadog, and Snowflake as examples of businesses that are demonstrating actual AI-driven growth. These are companies that are showing customers are spending money, deploying AI solutions, and integrating these technologies into their day-to-day operations. And personally, I think this shift is healthy for the market. Whenever a major technological revolution begins, there is always a period where excitement outruns reality. We saw it during the internet boom. We saw it during the cloud computing revolution. And we're seeing it again with artificial intelligence. Eventually, investors stop asking, what could happen? And start asking, what is happening right now? That transition is exactly what Dan Ives is describing. One of the most interesting parts of the interview comes when he talks about Snowflake. Dan describes Snowflake's latest quarter as a seminal moment for the software industry. What he's really saying is that Snowflake may have delivered evidence that the so-called AI ghost trade was overblown. The AI ghost trade is the idea that AI models themselves could eventually destroy large portions of the software industry. Some investors feared that powerful AI systems from companies like Anthropic or OpenAI would replace many existing software platforms. But Snowflake's results suggest something very different. Instead of AI replacing software companies, AI may actually be increasing demand for certain software platforms. Snowflake sits at the center of data storage and data management. As companies deploy large language models and AI applications, they need access to clean, organized, structured data. The AI model is only as good as the information feeding it. And this is where Dan makes a really important distinction. Most investors spend their time focusing on the obvious AI winners. They focus on semiconductor companies building chips. They focus on cloud providers running AI workloads. But Dan is looking at what he calls the second, third, and fourth derivatives of the AI revolution. In other words, who benefits after the chips are sold? Who benefits after the data centers are built? Who benefits when companies actually start using AI at scale? That's where names like Snowflake, Palantir, and MongoDB enter the conversation. Personally, I think this is one of the smartest observations in the entire interview. The biggest winners in technological revolutions are often not the companies everyone expects. During the gold rush, many of the people who became wealthy were selling picks and shovels. In the AI revolution, the equivalent of picks and shovels may be data infrastructure, and that brings us to what I believe is the central theme of Dan Ives' entire argument: data. According to Dan, data is the new oil. Data is the new gold. He repeats this idea several times because he believes it is the single biggest factor separating AI winners from AI losers. Think about it this way: artificial intelligence models are becoming increasingly powerful. Many of them are starting to look similar in terms of capabilities. Over time, AI models themselves may become somewhat commoditized, but data is different. Every company has unique customer data, operational data, transaction data, and proprietary information. That data cannot easily be replicated. That's why Dan believes companies that control and organize valuable data assets have a major competitive advantage. Snowflake owns critical data infrastructure. Palantir helps organizations organize and analyze enormous datasets. These companies are positioned directly at the center of the AI ecosystem. And honestly, I think Dan is probably right about this. The real moat in artificial intelligence may not be the model itself. The real moat may be access to unique, high-quality data. If everyone eventually has access to powerful AI models, then the differentiator becomes the information those models can access. That's why data-centric companies may continue outperforming. The interview then shifts towards Salesforce, and this is where things get particularly interesting. Dan acknowledges that Salesforce is making progress with Agentforce and its broader AI strategy. However, he also makes it clear that investors want much more evidence. Right now, AI-related revenue represents only a small portion of Salesforce's overall business. Dan argues that Salesforce must prove over the next several quarters that it can successfully monetize AI across a meaningful portion of its massive customer base. And this is where pressure starts to build. Salesforce has over 150,000 customers. If management can successfully integrate AI into those customer relationships, the upside could be enormous. But investors want proof, not promises, not presentations, not future roadmaps, actual revenue growth. I think this is a challenge facing many established software companies today. They are caught between two realities. On one hand, they have massive customer bases and strong brands. On the other hand, they must reinvent portions of their business model to remain relevant in the AI era. That balancing act is not easy. Dan specifically mentions Salesforce, Oracle, Adobe, and Intuit as examples of companies facing varying degrees of pressure. Some are adapting successfully, others still have significant work to do. What's interesting is that Dan doesn't sound bearish on these companies. He sounds cautious. He believes many of them can ultimately succeed, but success is no longer guaranteed, and that's a major shift from just a few years ago. Another part of the interview that stood out to me was Dan's discussion about the market becoming a winner's bracket and loser's bracket environment. This is actually a very useful way to think about today's technology sector. Not every AI company will win. Not every software company will survive this transition equally well. The market is becoming much more selective. Investors are rewarding companies with clear AI monetization strategies. At the same time, they are punishing companies that cannot demonstrate measurable progress. That selectivity creates tremendous opportunities, but it also creates risks. The easy money phase where nearly every technology stock moved higher together appears to be ending. Going forward, stock selection may matter more than ever. Dan even describes today's environment as a true stock picker's market, and I completely agree with that assessment. In previous years, investors could often buy a broad basket of technology stocks and do well. Today, identifying the specific winners may become far more important than simply owning the sector. Toward the end of the interview, the discussion takes a fascinating turn toward Tesla, SpaceX, and Elon Musk's broader vision. Dan makes one of his boldest predictions of the entire conversation. He suggests there is an 80% to 85% probability that Tesla and SpaceX eventually become much more formally connected. This is an idea that sounds almost unbelievable at first, but when Dan explains the reasoning, you can start to understand why he sees it as a realistic possibility. His argument revolves around data, engineering talent, and AI. Tesla generates enormous amounts of real-world driving data. SpaceX operates satellites, launch systems, and Starlink infrastructure. Both companies are deeply involved in advanced engineering and artificial intelligence. Dan believes the overlap between these businesses is growing. He describes it as a natural evolution of Musk's broader vision, and whether you agree or disagree with that prediction, it is certainly a fascinating concept to consider. Personally, I think investors sometimes underestimate how interconnected Musk's various companies have become. Tesla is no longer just an electric vehicle company. SpaceX is no longer just a rocket company. Both organizations are increasingly becoming data companies, AI companies, and infrastructure companies. That creates opportunities for collaboration that did not exist a decade ago. The other interesting point Dan makes is what SpaceX would gain from a deeper relationship with Tesla. His answer again comes back to data, engineering expertise, autonomous systems, and AI development. In his view, combining those strengths could accelerate innovation across both organizations. Whether that eventually happens remains to be seen. But it certainly highlights how much the future of technology is increasingly being shaped by data ecosystems rather than individual products. When I step back and look at the entire interview, I think Dan Ives is really delivering one simple message. We are moving beyond the early excitement stage of the AI revolution. The companies that will thrive are the ones that can turn AI into measurable business outcomes. Data is becoming the most valuable asset in the technology sector. Software companies with strong data positions are gaining an advantage. Legacy companies must prove they can adapt, and investors need to become much more selective about where they put their money. For years, many investors assumed that AI would create a rising tide that lifted every technology stock. Dan's message is that the opposite may be true. AI could become one of the greatest separating forces the technology industry has ever seen. Some companies will emerge stronger than ever. Others may struggle to remain relevant. And right now, Wall Street is working overtime to figure out which category each company belongs in. That is why this interview matters so much. Because we're no longer talking about the future of AI. We're talking about the companies that are already proving they can monetize it today. Now let's take a closer look at 3 of the smartest growth stocks investors can buy right now. These are 3 companies with powerful competitive advantages, strong growth drivers, and the potential to benefit from some of the biggest trends shaping the future economy. The first stock on our list is NICE Limited, ticker symbol NICE. Now I know what some of you might be thinking. What exactly is NICE? Unlike many popular technology companies that dominate headlines every day, NICE operates largely behind the scenes. Yet there is a very good chance that you've interacted with its technology without ever realizing it. And sometimes those are exactly the kinds of businesses investors should pay attention to. One of the biggest mistakes investors make is assuming that the best investment opportunities are always the companies everyone talks about. In reality, some of the strongest long-term compounders are the businesses quietly providing critical infrastructure that other companies depend on every single day. That is exactly where NICE fits into the picture. At its core, NICE helps businesses deliver customer service more efficiently. Its software platform powers interactions between companies and their customers across multiple channels. Whether someone is calling customer support, chatting online, sending messages, or using automated self-service tools, there is a good chance NICE technology is helping facilitate that experience. The scale of its operation is enormous. Its platform supports more than 20 billion customer interactions every year. Think about that for a moment. 20 billion interactions. That is not a niche product. That is mission-critical infrastructure for many of the world's largest organizations. What makes this particularly interesting is that customer service is becoming increasingly important in today's economy. Companies spend billions trying to improve customer experiences because they know that retaining customers is often far cheaper than acquiring new ones. As businesses become more digital, the need for intelligent customer engagement platforms continues growing. This creates a powerful tailwind for NICE. The company's customer list includes major global organizations that rely on its software to maintain efficient operations. Once a company integrates these systems deeply into its workflow, switching to a competitor becomes difficult, expensive, and risky. That creates a significant moat. And as investors, moats matter. Because when you find a company with a strong moat, you're finding a business that can potentially maintain pricing power, defend market share, and generate recurring revenue for years. One of the reasons I find NICE particularly interesting right now is that the market may still be underestimating how well-positioned it is for the next phase of artificial intelligence adoption. Many investors initially feared that AI would actually hurt companies like NICE. The logic seemed simple. If artificial intelligence becomes good enough to handle customer interactions on its own, wouldn't that eliminate the need for customer service platforms? At first glance, that sounds reasonable, but what has actually happened is almost the exact opposite. As AI capabilities improve, companies need sophisticated platforms that can deploy, manage, monitor, and optimize those AI interactions. In other words, AI is not replacing the need for customer service infrastructure. It's making that infrastructure even more valuable. And Nice recognized this opportunity early. The company has been aggressively integrating artificial intelligence into its offerings, positioning itself to benefit from the growing demand for AI-powered customer engagement solutions. One of the most important developments came through its acquisition of Cognigy, a specialist in agentic AI software. This acquisition significantly expanded Nice's capabilities and strengthened its position in one of the fastest-growing segments of enterprise software. The results are already becoming visible. While AI-powered and self-service solutions currently represent only a portion of the company's cloud revenue, that segment is growing rapidly. During the first quarter of fiscal 2026, recurring AI-related revenue grew by an impressive 66% year-over-year, reaching an annualized run rate of approximately $345 million. That growth rate should immediately get investors' attention. Because while many mature software companies struggle to generate meaningful acceleration, Nice is seeing one of its most promising business segments expand at an exceptionally strong pace. This is where the investment story becomes particularly compelling. Some investors look at Nice and see a company that grew revenue by roughly 9% last year. They stop there and conclude it isn't a true growth stock. But I think that view misses the bigger picture. The real question investors should ask is not what the company looked like yesterday. The real question is what the company could look like 3, 5, or even 10 years from now. And when you examine the company's positioning in AI-powered customer engagement, the answer becomes much more interesting. Customer service is evolving rapidly. Businesses increasingly want automated systems that can handle routine inquiries, resolve issues instantly, and operate around the clock. At the same time, they still need human agents for more complex interactions. The future isn't purely human or purely AI. It's a combination of both, and Nice sits directly in the middle of that transition. Its platform allows businesses to blend automation and human expertise in ways that improve efficiency while maintaining customer satisfaction. That gives the company a strategic advantage as organizations continue modernizing their operations. Another factor worth considering is valuation. Investor sentiment can create extraordinary opportunities when fear pushes prices too low, and Nice experienced exactly that. The stock fell roughly 65% from its early 2024 highs when investors became concerned that emerging AI technologies would disrupt its business model. But now we're seeing evidence that those fears may have been exaggerated. Instead of being disrupted by AI, Nice appears to be benefiting from it. In many ways, the market may have misunderstood where the company sits within the AI ecosystem. It isn't simply a company exposed to AI risk, it's increasingly becoming an AI enabler. And that distinction matters. Some of the best investments occur when Wall Street realizes that a narrative driving a stock lower was fundamentally wrong. I'm not saying Nice is guaranteed to become a massive winner overnight. No investment is guaranteed. But when I look at the combination of a strong market position, recurring revenue, AI integration, customer retention, and a stock price that still hasn't fully recovered from prior fears, I see a business that deserves serious consideration from long-term growth investors. The market often rewards companies that solve important problems. Nice helps businesses communicate with customers more effectively. That need is not disappearing. If anything, it is becoming more important with every passing year. And when you combine that reality with the accelerating adoption of artificial intelligence throughout customer service operations, Nice may be entering one of the strongest growth periods in its history. For investors looking beyond the next quarter and focusing on where technology and business are headed over the next decade, Nice Limited is a company that should absolutely be on the watch list. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second stock on our list is Viking Therapeutics, ticker symbol VKTX. Now this is where things start getting really interesting. Unlike the first company we discussed, Viking Therapeutics is not an established technology platform generating billions in recurring revenue. This is a biotechnology company operating in one of the most competitive and potentially lucrative markets in the world, and that means investors need to approach it differently. When you invest in a biotech company, you are not simply buying current revenue, you are often investing in future possibilities. You're investing in scientific innovation, clinical execution, regulatory progress, and the potential commercial value of a treatment that could eventually address a massive global problem. That naturally introduces more risk. But sometimes greater risk creates greater opportunity, and Viking Therapeutics may be one of the most fascinating examples of that dynamic in today's market. To understand why investors are paying attention to Viking, you first have to understand the enormous opportunity sitting in front of the obesity treatment market. Obesity is no longer viewed simply as a lifestyle issue. It is increasingly being recognized as one of the most significant health challenges facing populations around the world. The health consequences extend into numerous areas, including cardiovascular disease, diabetes, joint problems, and other chronic conditions that place enormous strain on healthcare systems. As a result, demand for effective weight loss treatments continues to rise, and what we're witnessing today could be the early stages of one of the largest pharmaceutical markets in history. Some projections suggest the obesity treatment market could approach $200 billion annually by 2035. Think about that number, $200 billion. Whenever a market opportunity becomes that large, investors naturally begin searching for companies capable of capturing meaningful market share. That brings us directly to Viking Therapeutics. The company's lead obesity treatment candidate is known as VK2735, and what makes this drug particularly compelling is that it appears to address several of the limitations investors and healthcare professionals continue to monitor within the broader obesity treatment landscape. VK2735 is designed as a dual agonist therapy that activates both GLP-1 and GIP receptors. Now, I realize that sounds highly technical, but the practical takeaway is what matters. Early clinical data has suggested that VK2735 may offer a combination of strong weight loss effectiveness, potentially faster results, and improved tolerability for patients. In simple terms, patients may be able to achieve meaningful weight loss while experiencing a treatment experience that is easier to manage. And in medicine, that matters tremendously. A treatment can be highly effective on paper, but if patients struggle to tolerate it or discontinue therapy, commercial success becomes much harder to achieve. The market is constantly looking for therapies that strike the right balance between efficacy and patient experience. That is one of the reasons analysts remain so interested in Viking Therapeutics. Another factor that makes the story particularly compelling is flexibility. According to available data, VK2735 may offer patients more control when transitioning into maintenance dosing after reaching target weight levels. That may not sound exciting at first glance, but it could become a meaningful differentiator in real-world usage. Healthcare providers often prefer treatment options that can be tailored to individual patient needs. And whenever a product offers flexibility without sacrificing effectiveness, adoption becomes easier. What's especially exciting is that Viking is not pursuing just one version of this therapy. The company is developing both an injectable version and an oral pill version. The injectable formulation is already advancing through Phase 3 development, while the oral version is expected to enter Phase 3 testing during the second half of the year. That second opportunity could be extremely important. Many patients simply prefer taking a pill over receiving regular injections. It's not complicated. People generally want convenience. If Viking can eventually offer both options, it could dramatically expand its potential addressable market. The oral version alone could become a major catalyst if future data continues supporting its effectiveness. Now let's talk about something equally important: risk. Because no matter how exciting the opportunity appears, investors should always understand what could go wrong. Biotechnology investing is rarely a smooth ride. Clinical trials can disappoint, regulatory hurdles can emerge, commercial execution can fall short, and market expectations can shift rapidly. Viking shareholders experienced that reality firsthand. Last year, the stock suffered a significant decline after investors reacted negatively to updates related to clinical trial results. Shares were nearly cut in half. And even though the company continues making progress, the stock has struggled to regain substantial momentum. For many investors, that creates uncertainty. But interestingly, Wall Street analysts appear far less concerned than the market. The overwhelming majority of analysts covering the company continue to maintain bullish views. In fact, consensus price targets have remained dramatically above the stock's current trading levels. Some analyst targets imply upside potential exceeding 200% from recent prices. Now, it's important to remember that analyst targets are not guarantees. Analysts can be wrong, markets can be wrong, investors can be wrong. But when you see such a large gap between current prices and projected valuations, it usually indicates that professionals believe the market may be underestimating future potential. Personally, I think what makes Viking Therapeutics so intriguing is the asymmetry. The company is not trying to create demand for a new market that may or may not exist. The demand already exists. Millions of patients are actively seeking better obesity treatments. Healthcare providers are searching for effective solutions. Governments and insurers are increasingly paying attention to the long-term economic impact of obesity. The market opportunity is already there. The question is whether Viking can successfully execute. And that's where investors need to make their own judgment. If the company continues generating strong clinical results, advances through regulatory milestones, and successfully commercializes its products, the upside could be substantial. If clinical outcomes disappoint or development timelines encounter significant obstacles, the investment thesis becomes much weaker. That uncertainty is precisely why the stock remains volatile, but it is also why the opportunity exists in the first place. Markets rarely offer extraordinary returns without some degree of uncertainty attached. For me, the most compelling aspect of Viking Therapeutics is that the company appears to be targeting a problem that will remain relevant for decades. Obesity is not a short-term trend, it is a long-term healthcare challenge. Any company capable of providing meaningful solutions could create enormous value for patients, healthcare systems, and shareholders alike. The road ahead will not be smooth. Biotech investing never is. But when you combine a massive addressable market, promising clinical data, multiple product formats, and strong analyst confidence, Viking Therapeutics becomes one of the more intriguing growth stories investors should be watching closely. And if management continues executing successfully, today's valuation could eventually look very different from where it stands now. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The third and final company on this list is one that many investors know, but I would argue very few truly understand. That company is Shopify, ticker symbol SHOP. Over the past several years, Shopify has evolved from being viewed as a simple e-commerce platform into something much larger. It is increasingly becoming the operating system for modern commerce. And that distinction matters. When most people think about e-commerce, they tend to focus on the websites where products are sold. But the real value is not the storefront itself. The real value comes from everything happening behind the scenes. Payments, inventory management, customer relationships, fulfillment, analytics, marketing tools, and business operations. That is where Shopify lives. The company is building an ecosystem that allows businesses to run nearly every aspect of their operations from a single platform. What makes Shopify particularly interesting today is that the stock has gone through a significant correction. Shares have fallen roughly 40% from their previous highs as investors worried about slowing growth, higher interest rates, and the potential impact of artificial intelligence on the company's competitive position. At first glance, those concerns may sound reasonable. After all, if artificial intelligence makes it easier than ever to build websites, won't that reduce the need for Shopify? That sounds logical until you look deeper. Building a website is not the hard part anymore. Processing payments is. Managing customer relationships is. Handling inventory is. Running a business efficiently is. Those are the problems merchants are trying to solve, and those are the areas where Shopify continues to provide value. This is why I think many investors are focusing on the wrong risk. The risk is not whether AI can create a website. The risk is whether another platform can replicate the complete infrastructure Shopify has spent years building. That challenge is far more difficult. The company already powers millions of merchants across the world. Every additional merchant creates more data, more insights, and more opportunities to improve the ecosystem. That creates a powerful network effect. The larger Shopify becomes, the more valuable the platform becomes to merchants. The more valuable the platform becomes, the more merchants join. That cycle can continue for years. What I find particularly encouraging is that Shopify is not ignoring artificial intelligence. Instead, it is embracing it. The company is integrating AI into its own platform, helping merchants build stores faster, manage operations more efficiently, and improve customer experiences. This is exactly what strong businesses do when disruptive technologies emerge. They adapt, they incorporate the technology, they use it to strengthen their existing advantages. And Shopify appears to be doing exactly that. One of the reasons investors became concerned was the belief that Shopify's growth story was slowing down, but the actual numbers tell a different story. The company's first quarter revenue growth accelerated to 34%, up from 31% growth in the previous quarter. Think about that for a moment. This is not a small startup. This is already a large company generating billions of dollars in annual revenue. Yet it is still growing at a rate many younger businesses would envy. That is incredibly impressive. Management guided for revenue growth in the high 20s for the current quarter. Some investors viewed that outlook as disappointing. Personally, I think investors sometimes become too focused on quarterly expectations. High 20s growth for a company of Shopify's size is still remarkable, and there is always the possibility that management is setting expectations conservatively. Many successful companies prefer to under-promise and over-deliver. Whether that happens here remains to be seen, but the business fundamentals continue to look healthy. Another reason I find Shopify compelling is because it aligns perfectly with a long-term shift in consumer behavior. Consumers increasingly want authentic experiences. They want to buy directly from brands they trust. They want relationships with businesses whose stories and values they connect with. That trend is becoming more powerful every year, and Shopify is positioned directly in the center of it. The company gives merchants the tools to create those direct relationships. It allows businesses to own their customer connections rather than relying entirely on third-party marketplaces. That is a significant advantage. As commerce continues moving online, businesses will increasingly want greater control over their customer experiences. Shopify helps make that possible. And that creates a growth runway that could extend well beyond the next few years. Of course, no investment is without risk. Competition remains intense. Economic slowdowns can impact merchant spending. Consumer behavior can change. Technology evolves rapidly. Those realities should never be ignored. But when I evaluate long-term growth stocks, I am looking for businesses with durable competitive advantages, strong leadership positions, expanding markets, and the ability to adapt. Shopify checks many of those boxes. The recent share price weakness may have created an opportunity for patient investors willing to focus on where the business could be 5 or 10 years from now, rather than what happens next quarter, and that is often where some of the best long-term investments are found. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.